Congratulations! We have an offer on your house. This video is going to go over the process and give you a little knowledge prior to our meeting to review your offer or offers so you can be better prepared to make an informed decision. The first thing to remember when looking at your offers is the offer price, while certainly it's important, is not the only or most important factor in the contract. So don't be tempted with a knee-jerk reaction to simply accept the highest offer. There are other considerations which we'll briefly go over, such as: is the buyer asking for a closing cost credit? Are they asking for exorbitant repairs? What type of loan are they getting? Is the buyer pre-approved or actually approved for their loan? How much is their deposit, their down payment? And how long before they can close escrow? Are they asking for any personal property to be included in the sale? And how long are their contingencies? As you can see, there are a lot of factors. So let's start with the first one. Is the buyer asking for a closing cost credit? Sometimes a buyer does not have enough money in the bank to cover both their down payment and their closing costs, so they'll ask the seller to pay a portion of their closing costs. Say you've got a full price offer at $500,000, but the buyer's asking for 3% credit. That's $15,000. So your purchase price is still $500,000, but you'll receive $15,000 less in closing because you gave it to the buyers, which in essence is the same as receiving an offer for $485,000 with no credits. Now let's talk about loans. What type of loan is the buyer getting? Is it conventional? Is it FHA or VA loan? Maybe you think, why does this matter? In the end, the money's the same. They get a loan and I get paid in escrow the amount that they purchased it for, minus the mortgage and selling expenses. Well, it does matter because each loan has its own conditions and lender requirements as far as condition of the house, and some loans forbid the buyer from making the required repairs in order to obtain the loan, which leaves you, the seller, holding the repair bills. So let's quickly go over the three most common loans. The first is a conventional loan. This is the most lenient loan when it comes to house condition. Buyers typically have a larger down payment, so the banks are a little less worried about the condition of the house. The next loan is the FHA loan. Buyers typically only have to put 3.5% down, and it's a government-insured loan, so they may require assurance about the house's condition. They may require a termite report with a Section 1 clearance. So let's talk about termite reports. Section 1, Section 2. When you get a termite report done, the inspector's not just looking for termites, he's looking for dry rot and fungus to the wood members in the home. The report will list damaged areas and classify them as Section 1 or Section 2 items. The Section 1 items are things that are already damaged with dry rot or fungus or an active infestation of any kind of termite, whether it's subterranean or wood termites. Section 2 items are items that are not already damaged, but areas that have conditions that, if not corrected, will lead to being a Section 1 item. Perfect example of a Section 2 item is a kitchen faucet that's leaking under the sink, and the wood at the bottom of the cabinet isn't damaged yet, but if that leak doesn't get corrected, the wood will eventually rot and become a Section 1 item. So FHA typically only is concerned with Section 1 items. However, a VA loan will require both Section 1 and Section 2 items to be corrected, and the termite company will have to certify that all those repairs have been done. Now, why does this matter to you as a seller? Because most times the VA lender will not allow the buyer to pay for those repairs. The seller has to pay for them, leaving you footing what could be a costly bill. VA also has other condition requirements that must be met, and again, buyers usually cannot pay for them. So when reviewing offers, we'll need to take into consideration the condition of your home, what kind of loan the buyer is getting, and what types of repairs may need to be made, and how much this is going to cost you. So speaking of loans, has the buyer been pre-qualified or pre-approved for their loan? And what's the difference? Pre-qualification letter simply means the buyer has spoken with the lender, verbally given their income, their expenses, and based on that non-verified information, lender will run some numbers, tells them what they're pre-qualified for. Pre-qual really isn't worth the paper it's written on. On the other hand, if the buyer has a pre-approval letter, or even better, an underwritten approval, then we know that the lender has taken the steps to verify their income, run their credit, and possibly even submitted their loan for underwriting. And they are in fact qualified to purchase your home. That's not to say something couldn't pop up during the loan process and cause a hiccup, but a pre-approval is much better than a pre-qualification. So let's talk about contingencies. In a standard contract, there are 3 contingencies that every buyer has, unless they choose to waive them. They have an inspection contingency, an appraisal contingency, and a loan contingency. All contingency timeframes start from the date of acceptance of the offer. An inspection contingency is a period of time when the contract gets accepted where they're able to get any and all inspections they want on the home to make sure they know the condition and make sure they still want to purchase it. The most common inspections are a home inspection, a termite inspection, and a roof inspection. Usually the inspection period for this contingency is about 10 to 17 days. Next is the appraisal contingency. The lender will hire an independent appraiser to come look at your home, take photos for the report, look at the condition, and then look for comparable sales in the neighborhood to come up with a value. The lender just wants to make sure that they're not loaning the buyer more than what the house is worth. Once the appraisal comes back, if it comes in at the purchase value, then all's well. If it comes in low, then we have a few options. We can either lower the purchase price to the appraised value, the buyer can come up with a difference, or we can meet in the middle with the buyer coming up with part of the difference and the seller also lowering their purchase price. Or the deal gets canceled and everyone walks away. The last contingency is the loan contingency. This is when the lender is gathering all of the buyer's documents, verifying their employment, having the loan underwritten, and giving the buyer conditions for approval documents to provide in order to satisfy the lender. This contingency is usually 17 to 21 days. So at the end of each contingency, the buyer will need to remove their contingency, ask for an extension, or cancel the contract due to something to do with one of the contingencies. The shorter the contingency timeframes, the less time we waste should they decide not to continue with the purchase. Once the buyer removes all contingencies, they are stating that they're moving forward with the purchase of the home. And should they back out or be unable to complete the transaction after that, that is when they risk losing their deposit. Which leads us to our next topic. How much of a deposit is the buyer putting down? The larger the deposit, the better. Let's explore this one a little bit. Say we're 30 days into contract. Buyers removed all their contingencies and we're supposed to close escrow in a week. You've already packed all your things, you've paid the movers to move your things to another location, possibly even already rented or purchased another home, and the buyer's loan falls apart. Or the buyer gets cold feet and cancels. Well, you've incurred some financial damages from that. In addition to the moving costs and the new housing costs, you now have to find a new buyer. In the meantime, you still have to pay your mortgage and thus are entitled to collect part or all of their deposit. If the buyer only put $1,000 down as a deposit, that isn't going to cover very much of your loss. Per the contract, the seller is entitled to the amount of the deposit or 3% of the purchase price, whichever is less. Now, if the buyer had put $5,000 into escrow, that's going to cover a lot more of your loss. If the buyer has very little skin in the game, they're not likely to be as concerned if they cancel at the last minute. However, if they stand to lose $5,000 or $10,000, they're going to think twice before canceling. So the amount of deposit is very important. A couple other items we'll discuss when we meet is whether the buyer's purchase of your property is contingent upon them selling the house. Is the buyer asking for any of your personal property, such as a washer, dryer, refrigerator, any other items to be included with the sale? So as you can see, there's a lot more to the contract than just the purchase price. When we meet to go over your offer, we'll discuss each of these items, and then you can make an informed decision as to which offer is best for you and your individual situation. As always, if you have any questions, I am always here to help.